Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thanks for joining us again. Please don't forget to like and subscribe. We're coming to you direct from France. No, we're not. Unfortunately, we're having some technical difficulties, so we thought we would pretend to be Supersport presenters, and we would use our old mic setup. Hello, Michael. Good to be with you again.
Morning, Robin.
Michael, we saw this week that America had released inflation statistics, and those came out worse than expected, but actually the markets rallied. So now I and the rest of the populace is completely confused. I thought bad news wasn't good news in this case.
Yeah. Well, I was actually hoping for some enlightenment from you, Robin. I think, Robin, inflation in the US was a little bit higher than expected. But I think we had to look back over the last couple of months and just take stock of what's actually happened. You know, oil prices are at the highest they've been in 18 months, unfortunately. And I think everybody will know that locally when petrol prices went up, what was it, R1.80 a litre last week or something like that. So unfortunately, oil prices are well into the $90 barrel range. Food prices are also ticking up, because of the Ukraine grain deal and things like that. So there's one or two things where things have been disinflationary in the last sort of year, and the trend is starting to turn a little bit, which is a little bit concerning. Remember that inflation is measured year on year. So inflation very seldom just falls in a straight line. It also got a lot to do with the base effect from last year. Okay. So a little uptick in inflation it's not great because the Federal Reserve meets next week, and obviously everybody's concerned whether they're going to raise interest rates again or not.
Yeah.
But by the same token, nothing ever goes down in a straight line, and because of the base, you have a little jiggles. We're going to have jiggles in our inflation. It's not going to keep on falling every single month. Definitely not. Yeah.
But Michael, one of the things we haven't talked a lot about in Money Morsel is just some of the woes in China. And I think last week we did see the Chinese government come out and kind of release sort of some of their stringent rules around lending, and that's a big factor into the property market, isn't it? Has this also kind of brought in a little bit of optimism on the side from China?
Yeah, so yesterday in particular, mining companies went absolutely crazy, and that's really is because of things in China. So I think it's fair to say that China's been completely underwhelming this year.
Yes.
Everybody expected a strong rebound in China post-COVID. We didn't expect it to be an infrastructure-led rebound in China. We expected it to be a consumption-led rebound, as people have been bottled up. Yeah. But China really has underwhelmed, and I think people are quite cautious in China. Youth unemployment is at 20%. Yes. There's an aging population. I think that they're starting to feel the impact of this political strife with the US. A lot of companies not investing more in China, but diversifying their supply chains to other countries or taking stuff back to Western Europe or the US. So I think if you add it all together, China isn't as strong as it was.
Yes.
The property market has been under a lot of pressure, which is always one of the big concerns in China. And yes, over the last couple of days, they've taken some quite decisive steps. Over the last 3 weeks, they've taken small little steps to try and sort of put their finger in the dike almost,
Yes.
And over the last couple of days, they've taken some more decisive steps, which I think the market's interpreted as maybe this is the sort of bottom for China, and that the economy will start to be a little bit firmer from here. So the mining companies had an absolutely record day. Well, not a record day, but I mean a stellar day yesterday. Iron ore prices are up sharply. Commodity prices are generally up sharply. Unfortunately, oil's also higher, not necessarily because of China, but obviously they're a consumer as well. So yeah, I mean, I think, your point, Robin, is that, we can be focused on one part of the world, but actually there's stuff happening all around the world that is interacting. So if you just think of the cogs, it's not just one cog that's moving, it's 100 cogs that are moving.
We've got to watch a few of them. And then lastly, Michael, we're stage 6, bordering on 7, who knows, 8 load shedding. And yet the Rand has steamed back from sort of 1920 back. I think it touched the mid 1880s earlier this week. Is that because they believe the government this is just transitional and we'll be back to normal soon, or is there more to it than that?
Yeah, Robin. Listen, I don't think our view on load shedding has changed. I think that we still have the view that that this is going to be the worst year for load shedding, and incrementally it will get better in 2024 and 25. Not to say that load shedding is disappearing in those years, just that it's going to get better, and with it comes margin recovery. But Robin, as we so often say in Intuition or in this forum, is that the movement in the Rand has got 10% to do with what happens here and 90% to do with what happens in the US. You know, and so you have a US situation, you have a Chinese situation, the dollar weakens, the other side of the seesaw, which is the Rand, strengthens. You know, so obviously you can look yesterday, and I mean, Eskom didn't put out some great numbers yesterday in terms of the outlook for load shedding for the next sort of 9 months, but you know, and you can say, well, the Rand's reacting to that, but actually the Rand's just reacting to global factors, you know. Okay. And you know, just maybe a final point, and this might sound a little bit counterintuitive, but in some ways the best thing for us as a country is to endure stage 6 for a couple of months longer, because it does accelerate people's plans to make an alternative arrangement, and in so doing, you actually sow the seeds of your own recovery. You know, when we were back at stage 1 in July and August, the demand for solar dissipated completely, fell through the floor. Exactly. So sometimes, you know, to keep the pressure on forces people to make a plan, and we actually sowing the seeds of our own recovery from that. Awesome. If we don't invest in solar, we're not going to improve.
Yeah. So great. Well, Michael, thanks for giving us color on all those movements. Thank you for joining us. Don't forget to don your Springbok Rugby shirt to support us against Romania on the weekend. 4 scrum halves on the scene, and join us next time for Money Morsel. Bye-bye.